Many people don't take advantage of safer investments in the stock market. Maybe it's because they are new and just learning, or they are looking to get rich quick and don't know about safer investments to get rich slow. These investments I'm talking about are called exchange traded funds, or ETFs for short. I like to call them buckets full of companies. In this video, we'll go over the types of ETFs available, how they work, and what to look for. A risky way to invest in stocks is to purchase individual companies and to not be diversified enough. Buying individual stocks, you can't be sure of what's going to happen. Maybe you bought some winners, but you also could have bought some losers. And hopefully you bought enough winners to make up for the losers. No one likes to lose money. An easy way to minimize your risk is to diversify. And an easy way to diversify is to buy ETFs. Remember, ETFs is like buying a bucket full of companies. They usually hold between 20 to 60 companies and can sometimes even hold more, depending on the ETF. Because you're so diversified with an ETF, you minimize your losses and can focus on your gains. Individual stocks are riskier. You can make a lot of money, but you can also lose a lot of money. With ETFs, you're more guaranteed to make money, but it will be at a slower pace and not as risky. Remember, we're trying to minimize risk so you don't lose money. This is probably the easiest strategy to use that will minimize your losses in the stock market. There's other ways to minimize risk, but we'll talk about that in another video. There are many types of ETFs on the market, and you're sure to find something you want. So if you want to buy some tech stocks, all you have to do is do a search for tech ETFs. But there's two things you should look for when researching ETFs. 1, the holdings, and 2, the expense ratio. The holdings is a list of companies in the ETF. And the expense ratio is how much the ETF charges. Yes, charges. Don't worry, we'll get into that. In this example, we'll look at Hero. This ETF focuses on the esports industry. First, we'll look at the holdings. This is a list of companies that you will be buying into when you purchase a share of Hero. It also shows a percentage of how much of the company is held by the ETF. Now the expense ratio. Let me explain what it is first. An expense ratio is what a fund charges to cover administrative, management, advertising, and other expenses. An expense ratio of 1% means that each year, 1% of your total fund's assets will be paid to the ETF fund to cover expenses. An easy way to remember is that if an expense ratio is 1%, then for every $1,000 you have in the fund, you pay $10 per year. So if you have $5,000, it would cost you $50 per year. Hero has an expense ratio of 0.50%. So this means that every $1,000 in the fund, it would cost $5. So if you decide to put in $20,000, it would cost you $100 per year. You can find expense ratios from other funds that are cheaper and some that are higher. But you have to ask yourself if it's worth it. Some things to ask yourself is, how much is the stock price? How much do you think you can make over time? How long am I going to hold it? Do I think the industry is going to blow up in the next few years? What are my goals? Once you answer your own questions, then make a decision if it's worth buying. Now let's go back over some points. ETFs are safer than individual stocks. Why? Because you own many companies with an ETF. The more diversified you are, the safer you are. Individual stocks are risky, and you could lose big, but you can also win big. There are lots of ETFs out there, but remember two things you should check: their holdings and their expense ratio. If you think you would like to invest in ETFs, leave a comment below and tell me which ETFs you want to invest in. And please don't forget to like and subscribe. Thank you for watching.